Good morning out there, folks. This is Darius Dale here to present our macro minute for Thursday, February 17th, 2022. Starting with markets, we have stocks down, commodities down, crypto down, dollar flat, global bond yields down this morning. Big movers, WTI, Bitcoin, and Ethereum all off around 2%. On the macro front, yesterday's January retail sales and industrial production data displayed a calming sense of resiliency in the U.S. goods economy. That dynamic is supportive of our view that the near term growth outlook remains too comfortable for risk assets to sell off in a major way. So headline retail sales accelerated to 56% on a seasonally adjusted annualized rate basis. That's the fastest growth rate we've seen since March of last year. Again, that seems overly inflated, but again, we contracted at a minus 27% annualized pace in December. So just a little bit of give back there. Control group 75% SAR versus a minus 39% contraction in December. So again, just a big numbers off of a big contraction. Industrial production, though, that's a pretty strong number off of a minuscule contraction that accelerated to a plus 18% seasonally adjusted annualized pace. Again, that's the fastest rate we've seen since March 21 as well. One positive dynamic today that may not be so positive tomorrow is the rapid unthawing of supply chains, as indicated by the sharp increases in capacity utilization, which itself is leading to a potential overbuilding in inventories. And so we saw capacity utilization took up a full 100 basis points to 77.6. That's the highest level we've seen since March of 2019. And then taking it to the chart this morning, we have manufacturing and trade inventories that accelerated to a SAR, season adjusted annualized pace of 28.6% or 28%. You got to take this chart all the way back to January of 1982 to find a faster season adjusted annualized growth rate of manufacturing and trade inventories. So clearly, supply chains are being unthawed. Clearly, there's a lot of overbuilding of inventories into what is an sort of overconsumption of goods, or at least that dynamic. We are well above trend in terms of our goods consumption, and that's something that could and should weigh on growth as we progress throughout 2022. Obviously, services consumption stands to offset that, but in our opinion, it will not offset that as much as consensus is hoping it will. With respect to today's probable range setups, we got an overbought signal in the 2-year US dollar inflation swap, gold, silver, Aussie dollar. So it's kind of an inflation expectations trade overbought a little bit, oversold nothing in the global macro risk matrix. S&P 500, that is neutral VAMs, minus 3.1% of downside versus 4.7% of upside. WTI, that is neutral VAMs, minus 8% of downside versus 6% of upside. Bloomberg Dollar Index, bullish VAMs, minus 0.1% of downside versus 1.7% of upside. 10-year Treasury yield, bullish VAM still minus 17 basis points of downside versus 17 basis points of upside. Bitcoin, bearish VAMs minus 15% of downside versus 3% of upside. Ethereum, bearish VAM still minus 19% of downside versus 4% of upside. And then lastly, gold with 5% of downside. It's at the upper bound of its probable range, and that's still neutral VAMs. And so, again, as you know, our probable range process and our volatility adjusted momentum signals, they're quantitatively linked. If we continue to hodl at the upper bound of the probable range, it could be, emphasis on could, a leading indicator for a bullish VAMS breakout in gold. So stay tuned for that. We'll be back here next week. Cheers.